Have you ever wondered how the commercial real estate market is performing on a global scale? Well, recent data shows that commercial property confidence is hitting an 8-year high. Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. Australia's commercial property sector is experiencing significant growth, with domestic confidence reaching an impressive 8-year high. A new report from a major lender highlights this positive trend, with the National Australia Bank Commercial Property Index climbing to plus 24 in the March quarter, the strongest result since 2017. Confidence is surging across most sectors and states, with expectations for capital and rental growth improving in nearly every corner of the market. In this optimistic landscape, Australia's mortgage brokers, especially those active in the commercial space, are seeing a moment of opportunity. As global investors look for stability amidst geopolitical volatility, Australia is emerging as a preferred destination. Kevin Thorpe, global chief economist at Cushman & Wakefield, notes that Australia is a safer bet with upside potential, particularly as the United States navigates a turbulent political climate. During the first Trump presidency, Australia's office markets remained resilient, and capital markets thrived until the pandemic hit. The industrial sector and central business district hotels are leading the charge in Australia's commercial property scene. With a national industrial vacancy rate of just 3.2% and robust rent growth expectations, industrial sentiment has risen to plus 46. Meanwhile, central business district hotels are boasting a sentiment score of plus 50 and the highest forward confidence metrics of any sector. Even in Victoria, which lags behind, there's a forecast for recovery in office values by 2027. Momentum is also building in listed property. According to J.P. Morgan, there's been an increase in weightings to real estate investment trusts for 4 consecutive months, with 25% of fund managers now overweight REITs. A potential rate cut expected in June is fueling optimism, with National Australia Bank's economists predicting the cash rate could drop to 2.85% by November. Debt funding conditions are improving and investor appetite is returning. For mortgage brokers, this means increased commercial activity across industrial, hotel, and residential development sectors. Clients may seek to refinance or secure new debt against appreciating assets, while developers ramp up plans to convert land-banked stock or pursue new acquisitions. Australia's relative insulation from a US-China trade conflict could also prove advantageous, as any redirection of building materials within the Asia-Pacific region may lower construction costs. Morgan Lewis and Bockius LLP has played a pivotal role in advising on a significant retail fund initiative. Investment manager Nuveen Real Estate has successfully raised $320 million for a fund specifically targeting grocery-anchored, necessity-based neighborhood retail properties. This initiative reflects a strategic focus on retail assets that cater to everyday consumer needs, emphasizing stability and resilience in the commercial real estate market. The fund's formation, guided by Morgan Lewis, highlights the ongoing interest in essential retail spaces, especially those that serve as community staples. With the retail sector undergoing transformations due to changing consumer behaviors, investments like these indicate a calculated approach to capitalize on properties that maintain steady foot traffic and demand. These grocery-anchored centers are viewed as pivotal in sustaining local economies and providing consistent returns. This development aligns with broader trends observed in the commercial real estate landscape. As macroeconomic factors influence investment strategies, funds focusing on necessity-based retail properties are gaining traction. This trend is evident in both Canadian and American markets, where investors are seeking opportunities that offer long-term value and stability amidst economic fluctuations. In Ontario's regions like Kitchener-Waterloo and London, there's a noticeable demand for retail spaces that align with this necessity-based strategy. These areas, known for their vibrant communities and economic growth, provide fertile ground for such investments. In the United States, similar patterns can be seen, with investors prioritizing retail properties that offer essential goods and services, thereby ensuring a steady customer base and sustained income streams. Audrey Henvey reports that a significant redevelopment is underway at the former Neiman Marcus corporate headquarters site in Dallas, Texas. NexPoint Diversified Real Estate Trust has laid out plans for a mixed-use transformation of the 42-story tower and surrounding land at 2711 North Haskell Avenue. Initially acquired by NexPoint in 2018, the site is set to undergo 4 phases of development. The first phase, known as the Apron, will see the construction of 8 6-story buildings encompassing 465 mixed-income multifamily units, with 20% designated as income restricted. Additionally, the Apron will offer 15,610 square feet of ground floor retail space, and renovations of 6 existing parking garages are included in this phase. Phase 2 will focus on the City Place Tower itself, converting 27 floors into multifamily residential units and 8 floors into a hotel. 5 floors will remain office space, with event and conference facilities planned for the ground level and the 42nd floor. Notably, the redevelopment plans do not specify the future use of floors 11, 12, and 13, which previously housed Neiman Marcus's new corporate headquarters, established in 2023. Despite the lease termination notice from Neiman Marcus Group for their space at City Place Tower, NexPoint maintains that the lease does not permit such termination. However, negotiations with Neiman Marcus are ongoing, and NexPoint plans to market the vacated office space. Once completed, the redevelopment project will introduce 970 new residential units, including 194 affordable units. Financing for the project includes a senior loan from NexBank, accounting for 55% of the funding, with the remainder sourced from preferred financing and owner equity. Dallas City staff have proposed a 10-year tax abatement valued at approximately $13 million, contingent on the developer meeting specific criteria. This redevelopment is expected to have a significant impact on the surrounding area, addressing the demand for housing amid Dallas's rapid growth. Nunzio Mark DeSantis is listed as the architect for the project, and Gordon Highlander has been selected as the general contractor. The redevelopment proposal is scheduled for review by the Dallas City Council on May 28th, with construction anticipated to commence in the fourth quarter of 2025. Nashville's commercial real estate market is facing a significant challenge, as recent appraisals reveal substantial financial losses in the office building sector. According to a report by Sophia Young, the latest evaluations have shown that several office buildings in Nashville have experienced a decline in value, amounting to millions of dollars in losses. This downturn is attributed to a combination of factors, including changing work habits and a shift towards remote work, which has led to reduced demand for traditional office spaces. The impact of these financial setbacks is not limited to Nashville alone. Across the United States, office buildings are grappling with similar valuation issues as companies reassess their need for physical office spaces in a post-pandemic world. This trend is reshaping the commercial real estate landscape, prompting property owners and investors to explore alternative uses for office buildings, such as converting them into residential or mixed-use developments. In contrast, the multifamily and industrial sectors continue to show resilience and growth. In regions like Kitchener-Waterloo, London, and Cambridge, Ontario, there's a noticeable demand for multifamily housing, driven by urbanization and the influx of tech companies. This demand is mirrored in American cities that are experiencing a similar tech boom, indicating a cross-border relevance in the commercial real estate market. Retail properties, particularly those anchored by essential businesses, are also navigating the shifting landscape with a strategic focus on stability. As seen in both Canadian and American markets, necessity-based retail spaces are gaining traction as investors seek long-term value amidst economic fluctuations. This trend underscores the importance of adapting to consumer behaviors and focusing on properties that cater to everyday needs. Ultimately, the ongoing changes in the office sector highlight the need for adaptability and innovation in commercial real estate. Stakeholders are increasingly looking towards flexible solutions and diversified property portfolios to mitigate risks and capitalize on emerging opportunities. As the market continues to evolve, staying informed and proactive will be crucial for navigating the complexities of the commercial real estate industry. In the ever-evolving landscape of commercial real estate, the role of real estate assets in financial firms' mergers and acquisitions is becoming increasingly prominent. According to a report by JLL, mergers and acquisitions in the financial services sector have rebounded sharply, with a significant focus on integrating real estate into these strategies. Aaron Hagland, Managing Director of Financial Services at JLL, emphasizes the importance of treating commercial real estate as a strategic lever rather than a mere cost center. This shift allows organizations to unlock value, retain talent, and execute growth strategies more effectively. Real estate plays a crucial role in translating mergers and acquisitions ambitions into operational reality by serving as the physical expression of a company's culture and brand. The report highlights that the landscape of mergers and acquisitions in financial services remains highly regionalized, with real estate implications closely tied to market maturity, regulatory outlook, and subsector dynamics. In this context, local real estate knowledge becomes invaluable, underscoring the importance of incorporating commercial real estate leaders early in the due diligence process. One of the key benefits of incorporating commercial real estate into mergers and acquisitions is achieving scale and operational efficiency. With real estate typically being the second largest cost for companies, it becomes a significant consideration in the process. Moreover, the workplace serves as the physical manifestation of a company's culture and brand, improving employee experience and supporting integration between merging companies. Ignoring real estate in mergers and acquisitions can lead to risks such as redundancies and increased portfolio risk. However, focusing on property liabilities, lease commitments, and asset conditions can mitigate these risks. Positive investment opportunities can reshape the company's footprint to reflect new business models, talent strategies, and customer reach, supporting a unified culture and scalable growth. To summarize, any mergers and acquisitions process should involve real estate stakeholders from the outset. Aaron Hagland suggests incorporating commercial real estate leaders at the front end of the process before due diligence begins. Successful transitions are those where real estate teams act early, collaborate cross-functionally, and approach portfolio decisions with a blend of data and future-focused vision. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.